Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Kohls, their shares surged as much as 105% in early trading. Now their shares, well, they're up about 36%. It's just a record move. A lot of mentions by retail traders on social media. Let's bring in someone who knows a little bit more about this. Let's bring in Mary Ross Gilbert. She's Bloomberg Intelligence Senior Equity Analyst covering all things retail. So, Mary, can you tell us, is this a meme stock?
Well, it's acting like a meme stock, that's for sure, Lisa. And as you pointed out, it was on social media. It looked like midday yesterday there was a post showing a Bloomberg chart and showing the short interest. And if you look at the number of shares or the shares borrowed versus the total float, it was about 49%, which is pretty high. And it's near a historic high, at least over the last couple of years. And so the post sort of circled that, and then it identified and noted, hey, how can you be short this stock and sleep well at night? And then apparently that kind of triggered other posts throughout, I guess, into the evening yesterday. And so, of course, in pre-market, we saw the share surge, as you pointed out, over 100%. And, yesterday the stock was up about 8%. We saw retail stocks on the move yesterday as well. And so it could be, as one of your earlier commentators discussed, with such a strong market overall, this is a sector that has been beaten down largely with tariffs and then, of course, with execution issues when we're talking about Kohls.
Mary, has the company said anything either last evening or today in response to the stock movement?
Absolutely not. There are no releases from the company.
So, is this something? What are you hearing from the clients that you talk to, institutional investors that you talk to? How are they? Are they selling into this? What are they doing?
Yeah, I'm not hearing anyone discussing exactly what their activity is, but you can imagine that there's probably a fair amount of hedge funds involved. And so when you think about it, the company is highly levered, they have bonds, and hedge funds typically will take a position, let's say, in certain bonds, and then they'll go short the stock. So I think we do have some of that activity, and that's how they're positioned. And of course, there could have been a short squeeze that was triggered with this activity. This is usually what we'll see in a situation like this. So I think that's kind of what we're seeing in the activity in the shares.
And Mary, before all this news came out, how was the stock doing before? How was Kohls performing before all this?
Oh, it's been atrocious. The stock is, you can look at 3 years, 2 years, 5 years, year to date, and the stock has been off significantly, and that's due to falling revenues. If you look at the revenues over the last few years, it's down over $2 billion. And really, when you look at the core business, it's down even more. And that's even with adding, $1.8 billion in revenues from Sephora. So it shows that there is trouble in the core business. And of course, they've rotated through several CEOs, and they're on an interim CEO as they hunt for a permanent, their fifth CEO in just over 2 years.
Oh, boy. Jeez. All right, Mary, that explains it all. Mary Ross Gilbert, thank you so much for joining us. Mary Ross Gilbert, she covers the retailers for Bloomberg Intelligence. She's based out there in our Los Angeles bureau.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
General Motors, that's what we want to get to. It took a big hit from President Trump's tariffs. Are you ready for this, Paul? Okay, $1.1 billion profit hit. Wow. So what kind of impact is that going to have for the company? Well, we want to hear from the expert about all this. So let's find out, and let's go to David Welch. He's Bloomberg Detroit Bureau Chief. He's joining us live from Detroit. So, David, were you surprised with that figure, $1.1 billion? We heard from Stellantis, too, kind of saying something similar yesterday.
No, not surprised at all. GM said they were going to take a $4 to $5 billion hit, or at least that they had $4 to $5 billion in exposure this year to tariffs, and that they would only be able to offset about 30% of it. And the measures they're using to offset that, you really won't see till the second half. So I thought there would be a pretty big hit to it. I don't think the street was surprised either, because the forecast for GM's earnings were for a pretty big drop off of the second quarter of last year already. GM did better than that because they did have some things, better profits in China than we saw a year ago, and better sales in the U.S. that helped them. But overall, pretty tough quarter, and it really shows that the car companies are going to have a tough time getting anything close to pre-tariff profits going forward, because there's just no easy way to get around them.
So, I mean, is what we're to take away from the Stellantis numbers yesterday and the GM numbers today is that the auto manufacturers, for whatever reason, maybe they're just not able to, or they chose not to pass along the bulk of their cost increases to consumers? Is that a policy, or is that just an economic reality?
It's an economic reality. And look, Stellantis has a lot of other issues. They're going to do some pretty heavy restructuring, which they talked about yesterday. But look, we're at a period right now where interest rates are at pretty high levels. You have historically, not record, but pretty close to record new vehicle prices in the U.S. right now. Average monthly payment, well over $700 a month. We have a record number of people, I think, paying more than $1,000 a month for their monthly payment. Cars are expensive. So, you can go out there and say, hey, I'm going to pass this tariff cost on to consumers, or even some of it. But if consumers don't pay it, then you just lose the sales. And you haven't seen huge price increases. You've seen small ones. You've seen companies sneak in, some bigger fees for transporting the vehicle, for example, things like that. But it's just not, they just don't really have the ability to push in big price increases to pass on, in GM's case, $1 billion worth of tariffs in a quarter.
And it's not just tariffs. What else affected profits for GM? I mean, how's their inventory for electric vehicles?
They built that up in the quarter, and since the vehicles lose money, they have to account for that. That cost them, I think it was $600 million in the quarter. They had $300 million because they've had a big engine recall, so they've had higher warranty costs. It wasn't just because of that recall. They've had other issues, and they're working on that. Some of these quality issues you're seeing that are costing companies more in warranty and recall type costs are all the software that goes into electric vehicles. These are kind of first times out with new software, new infotainment systems, power management systems in these vehicles. And it's just tough for them to go out there and not be buggy, right? Think about how many times there's something on your smartphone that needs an update, and fixing that with a car is often more expensive. So some of it was related to that, and actually, they saw pricing go down with some of their fleet customers. There's a lot of competition out there for the corporate and fleet business, and they actually saw some downward price pressure there too, and that cost them $200 million. So a lot of things in the quarter that pushed profits down, but tariffs are the real story here.
David, you're out there in Detroit. You live and breathe this stuff every day. What's the feeling in Detroit as it relates to this evolution to EVs, and how will the tariff and the tariff impact on profitability? Is that going to slow this down even more, do you think?
I do. I think everything the Trump administration is doing is really going to slow the EV transition. First of all, the obvious one is come September, they're going to be getting rid of the $7,500 tax break for qualifying electric vehicles. But with tariffs, you've got battery components, electronic components, wiring harnesses. There's more wiring in an EV than in a conventional vehicle. All that stuff adds to the cost of vehicles that already lose money. Some of them are actually built overseas. In the case of Hyundai, they make some of theirs overseas. GM makes a couple of its EVs in Mexico. They do qualify for USMCA, but there are still some parts component tariffs that they can be hit with on some of these vehicles. And so you add cost to vehicles that are already pretty expensive, and you can't pass it on. If you do, even fewer people will buy them. Companies may have less incentive to build and sell them if they lose even more money on these. So that's going to hurt as well. And then, of course, Trump's rhetoric for people who are politically right of center and pretty far right is that EVs are a dumb purchase and they don't work for you. And I think that hurts sales as well. So all of this is just not good for the momentum that EVs had in the U.S. Before Trump got in office.
Yeah. So David, last month the company said it would shift some production to the U.S. from Mexico. So what other changes can we expect to see from the company, like in the last minute or so we have left?
I think you'll see them try to bring more of the parts they buy into the U.S. So they'll be encouraging their suppliers to do what they're doing, which is move some production to the United States, and that'll take time. And you may see them make some more production-related moves. What they've done is pretty big, so I'm not anticipating any big announcements. But as they look at this and they find other ways to do it, you might see more vehicles, more parts built here in the U.S.
Thank you so much, David Welch, Bloomberg Detroit Bureau Chief, talking about GM earnings and so much more.
I'm looking at GM right here. If you go GM Equity FA, just brings up the financial statements. Their net income margin is 5%.
Okay.
That's it. They got like no margin, no profit margin. Anything goes wrong for these auto companies and they get screwed.
You always say, I never understand the auto companies.
I just don't get it. And oh, by the way, my top line's flat. I mean, it's a
high volume, low margin business.
We'll make it up on volume, I guess. It's one of those businesses. So it's just a tough business. And then you throw on top of it tariffs. And then, oh, by the way, I have to change my entire industry that I've built up over the last 100 years to go electric. Yeah, I'll invest in that. I mean, I don't know.
We got to shift tough. Production, U.S. to Mexico. It's never ending for them.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
You were listening to Bloomberg Intelligence. I'm Lisa Mateo alongside Paul Sweeney. And we are in the thick of earnings season, right? Among those companies today, one of them, Coca-Cola. A beat on second quarter sales growth profit. But it's another headline that's getting some attention. They are launching a new Coke product that's made with cane sugar. So here to tell us more about it is Kenneth Shea. He's Bloomberg Intelligence Senior Consumer Products Analyst. Kenneth, thanks for joining us here from Princeton. How much of an impact did the president have on this decision from Coke?
Yeah, hi, Lisa. Well, it's hard to say, but it certainly is in sync with what Coca-Cola has been doing for a long time, and that is keeping its pulse on what the consumer wants to do. It has a lot of assets at its disposal, and a cane sugar product is not novel to Coca-Cola. I mean, it's produced in the U.S., largely more outside the U.S., but in the U.S. on a selected basis. So it's really just going to expand that. It may have been prompted to a degree by the president's tweets or whatever, but it's certainly in sync. Like I said, there's an audience out there that prefers sugar-based as opposed to high fructose corn syrup-based full-calorie sodas, and they're going to play into that. Most likely, it's going to be a brand Coke extension, and it's going to be sold at a premium price in selected markets to give it an aura of exclusivity, I'm guessing, to command those prices. And so it just has a little more excitement. It's one of many things Coke is doing now on the innovation front.
So from Coca-Cola's economic perspective, do they care which ingredient they use?
Well, it depends, Paul. It depends if they can capture the premium price they're going to, price it at. Cane sugar costs more than high fructose corn syrup. Corn is a heavily subsidized crop in the U.S. They built their supply chain around HFCS because of that. And most consumers, they're really, they don't really notice the difference. Some do, but by and large, they've grown that franchise very well. But I guess, some tourists who go to Mexico and they taste the sugar, cane sugar Coke down there, and they say, you know what, this is really good. And they want to capture the same experience in the U.S.
I'm going to Chipotle today, and they do offer the Mexican soda there.
Can I give you the history of high fructose corn syrup? It was in the 1970s with high inflation and high sugar prices. President Nixon said, do something about this. And his guys said, well, we can make a sugary tasting stuff from corn from American farmers. And
there you go.
Thus, high fructose corn syrup, which most doctors say is like poison to your system. But there we go.
There goes.
John Tucker with the value added there. Let me shift gears here. What is a Zin patch?
A Zin patch? I thought you had a patch. I think they made a pouch.
Pouch.
The Zin pouch is a pouch. It's an oral tobacco product. Actually, Zin doesn't even contain tobacco. It's a synthetic product that is laced with nicotine that is a facsimile for tobacco, which a lot of people will say causes harm, and a lot of people are right. So this is a product that people can get their nicotine buzz in a hands-off kind of way. Doesn't emit smoke, doesn't offend your neighbor that you're working with, and it's done really, really well. So those are the Zyn pouches that are doing really well. Yeah.
I thought it was Zinfandel, the wine. That's no kidding.
I get that pouch.
So, but I mean, it's big enough a business, Ken, that Philip Morris would call it out.
Oh yeah, Zyn, it's about 8% of the sales, I believe, at this point, but it's growing, at a 20-30% rate, as opposed to cigarettes, which are flat, if not down. But IQOS is their smoke-free device segment, which is doing very well. But at the law of large numbers, at some point, that's going to slow. And Zyn is filling the gap to keep the overall volumes in a positive trend. They price these things very high. There's not a lot of competition in this space. So, one of the things investors would say about the world of tobacco is because it's so consolidated, they can pass on a very high pricing. And that's what really drives the top line and, the cash flows and so on. And Zyn plays very, very, very well into that model.
And how does it fare as far as we hear about e-cigarettes, vaping, things like that? How has Philip Morris been doing competing with this category?
So they have a product called Vive, which is their e-vapor product, as opposed to what they call heat not burn, which has actual tobacco in it. And they would say is a more appealing alternative for smokers who are trying to quit. It's a lower margin product. It's kind of seen by Philip Morris as a kind of an entry-level product. For those who are trying to move away from combustible cigarettes, they can turn to e-cigarettes, a low-cost method. And their hope is that, even though it's a low-margin product, their hope is that they can get that consumer maybe at some point to trade up to their heat-not-burn product, which is, a more profitable product for them.
All right. Good stuff. I mean, I learned about the Zyn pouch today. How about
Zinfandel.
that? It's not Zinfandel. Okay. All right. Very good. So good stuff there. Ken Shea, thanks so much. Ken covers all those consumer products companies for Bloomberg Intelligence. Appreciate getting a few minutes of his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. Let's talk about Lockheed Martin. Put out some numbers, disappointing here, took some losses here. Let's break it down with Will Lee, aerospace and defense analyst for Bloomberg Intelligence. Will, Lockheed Martin, I mean, they just do everything. What happened in the quarter?
Yeah, so I mean, if you look at the quarter, the performance was muddled by this hefty $1.6 billion chart program losses, and then another $169 million of other charges. There was the NGAP write-off. I think that was around like 66 million.
Let's go back to the big one, 1.6 billion. So what's that for?
So out of that 1.6, 950 million is for a classified aeronautics program.
So they can't tell us what
they can't tell us what it is. But if it's something that big and it's been going on, and in fourth quarter, they also recorded another $440 million or $477 million.
Let's stop doing that program then. I don't know.
They could tell you, but then they have to kill you.
Well, given that it's a huge program and they're taking over $1 billion of charges, what could possibly be so important and so big? And most likely is the unnamed sixth generation ISR.
What's an ISR?
Intelligence, surveillance, reconnaissance. So think of it as the replacement for the SR-70. SR-71.
Oh, now we're talking. SR-71.
72.
72. Okay.
So if you think about in that respect, Boeing has the F-47. That's the sixth generation fighter jet. That's going to be the biggest sixth generation program. Navy wants their own sixth generation, the FAXX. I think that Northrop has the inside track to win that, given that DoD doesn't want to make the same mistake that it made with F-35, with F-35, F-22, given Lockheed both control of the fifth generation fighter. So they break up into multiple defense contractors and have more resilient industrial base. So with that mindset, Boeing has F-47, Northrop has the FAXX, and Lockheed could potentially have the sixth generation reconnaissance aircraft.
So will all those numbers, my son would be having a field day with this conversation right now. He is so into this. Is this typical of defense contracting environment? I mean, growth is marginal there. You were mentioning a number of numbers before. Is this typical?
I mean, to this large extent, this is sort of unusual. I mean, Lockheed teased that they were looking at additional charges after the quarter. They didn't mention or indicate how large that magnitude was. So this sort of caught the street by surprise, the size of it. But I mean, I think it just shows that this is a key program that's going to keep going forward. But even if you just strip out all the charges from the quarter and you look at the underlying performance, the performance actually was not bad. In the second quarter, aeronautics grew 7% on high F-35 volumes, and the F-35, and they also took up the cumulative profit booking rates on the F-35 in the quarter. And the missile and fire control segment, it grew 11% on strong demand on tactical and strike missiles. So you're talking about the JASSM air-to-surface missiles, the LRASM anti-ship missiles, and the GIMLRs that are used on the HIMARS. Those are rockets that we've been sending over to Ukraine.
I'm looking at the comps. They're all trading up on the year. Defense contractors' stocks are doing great this year, with the exception of Lockheed Martin. It's down 11% year to date. What up with that?
Well, I mean, the biggest headwind is the F-35. You have the F-35 is the news. You have talks of why do we need to have F-35s in the fiscal 26 budget request. The Air Force cut the number of F-35s to 24, and that's down from 44. So across the board, I think that's the biggest headwind on Lockheed, and the fact that you're not seeing that more. You're seeing flat revenues and no real margin improvement. So I think those are the two big headwinds.
Yeah, can you get into that a little bit more? Like RTX Corp, Northrop Grumman, like what are they doing better that Lockheed isn't?
Well, I mean, in terms of with Northrop, they're levered to the B-21 program and the Sentinel. So with the B-21, you're hearing talks of the Air Force looking to accelerate production, add more quantities. And that program right now is in this EMD phase, engineering, manufacturing, development. So think of it as sort of this, it's still in the development, low-rate production phase. But then it's going to transition to a production phase. And when it goes to a production phase, you can see potentially higher quantities. And Northrop talked to that on their earnings call this morning, saying that we're in discussions with the Air Force. And if we increase the production rate, we might have to make additional investments, which means a headwind to earnings. But at the same time, they could potentially realize profit on these low-rate initial production lots and not to exceed subsequent follow production, whereas before they were expecting no profits on the LRIP phase and some profit on the next NTE phase.
All right. It just seems like it's good to be in the defense business. It just seems like, we spend money on defense year in and year out. Lockheed Martin had a tough day today. It is down 6%. LMT is the ticker. Will, thanks so much for joining us. Will Lee, aerospace and defense analyst for Bloomberg Intelligence, breaking down the LMT data here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.